What's up, friends? Today we are breaking down a stock that's been hyped like crazy. SoFi Technologies, ticker symbol SOFI. Is this the future of digital banking or just another overvalued fintech story? Let's find out. Welcome to my YouTube channel. If you are into simple, no hype stock analysis, you are in the right place. SoFi is a digital-first financial platform that aims to replace traditional banks with an all-in-one mobile experience. It started with student loan refinancing, but has expanded into personal loans, home loans, and full banking services. Today, users can save money, invest in stocks and crypto, and manage finances all within a single app. The company also owns a regulated bank, allowing it to hold deposits and lend directly. On top of that, SoFi runs a technology platform that powers fintech services for other companies. Its main goal is to become a financial super app where users don't need multiple financial providers. It has market cap of $23.5 billion and is currently trading at $18.36. Now, looking at revenue. This is where SoFi really starts to impress. They have grown from about 751 million in 2020 to nearly 4.7 billion in 2025. That's massive expansion in just a few years. But what's more important is the middle phase. As you can see, from 2021 to 2023, growth really accelerated, jumping over 60% in 2022 and 2023, which slows when the business really took off. After that, growth starts to normalize a bit, coming down to around 25 to 30%, which is expected as the company gets bigger. Let's move to the profitability section. Now, this is where things get really interesting. If you look at EPS, SoFi was deeply negative in the early years, around minus 4.3 in 2020, and losses continued through 2021 and 2022. But what stands out is the sharp improvement after that. By 2023, losses narrowed significantly, and by 2024 and 2025, EPS turns positive at around 0.39. That's a major shift from heavy losses to profitability. If we look at the net margins, same story. They were heavily negative before even hitting around minus 48%, showing the company was burning cash to grow. But over time, margins improved steadily. And now we are seeing double-digit positive margins above 10%. This clearly shows SoFi is moving from a pure growth phase into a profitability phase, which is critical turning point for any fintech company. Now, looking at free cash flow, this is one area where we need to be a bit careful. SoFi has shown improvement compared to its weakest period, but free cash flow is still negative. In 2023, free cash flow was deeply negative at around minus 7.3 billion. Then improved to around minus 1.28 billion in 2024. But in 2025, it moved negative again to around minus 3.99 billion. So even though the company is becoming profitable on paper, it is still not consistently generating strong cash. So the key point here is, SoFi is improving on profitability through EPS and net margins, but from a cash flow perspective, the business is still not fully mature. That means investors should not only look at earnings, they also need to watch whether SoFi can turn its accounting profitability into consistent positive free cash flow over time. So overall, free cash flow is still a risk area, but definitely something to monitor closely. Let's discuss about the company's valuation. Now, this is where everything really starts to make sense when we combine valuation with growth and profitability. If we compare SoFi with Lending Club and Ally, which are more traditional lending and banking players, SoFi growing at around 26%, while Lending Club is closer to 15% and Ally is actually showing negative growth. So right away, you can see that SoFi is operating in completely different growth phase. But here's the part that really matters. Despite the higher growth, SoFi net margins are already around 10%. which is almost identical to the lending club and even stronger than Ali. And that's a big deal because usually companies growing this fast are still burning cash. But SoFi has already reached a stage where it can grow and generate profits at the same time. Now let's bring in Upstart. This is more of a high growth, high risk lending model. Growth is much higher at around 60% plus, but margins are weaker and the valuation is significantly higher with a PE above 70. So compared to that, SoFi looks much more balanced. It's not chasing extreme growth like Upstart, but it's also not slow and mature like traditional banks. So what we're really looking at here is a company in transition, not a traditional bank, not a pure high risk growth play, but something in between. And that's exactly why the market is giving its premium valuation. At this point, the question is not whether SoFi is cheap or expensive, it's whether the company can continue executing, maintaining growth while improving margins. Because if it does, this valuation can be justified. But if growth slows down, the premium can disappear very quickly. Now the big question, is SoFi actually overvalued or is the current price fair? To answer that properly, we first need to calculate a fair value range. For this, I'm using a forward EPS of around 0.39 and then we apply a reasonable PE multiple based on the company's growth profile. Now, one important thing here, the PE range of 25 to 40 is not random. Traditional banks usually trade at much lower PE ratios, somewhere around 10 to 15, because growth is slow and mature. But SoFi is different. The company is still growing revenue around 25 to 30%. Margins are improving and it has recently transitioned into profitability. So the market values it more like a growth fintech rather than a normal bank. That's why I'm using 25 PE as a more conservative case where growth slows down over time, and 40 PE as a strong growth case where the company continues scaling successfully. Now let's do the math. Using the lower PE range, 0.39 multiplied by 25 gives us around $9.75. And using the higher growth multiple, 0.39 multiplied by 40 gives us around $15.6. So based on this approach, SoFi's estimated fair value range comes to roughly $10 to $16 per share. Now compared to the current stock price, around $18, the stock is trading above its calculated fair value range. Now before getting too bullish on SoFi, we also need to look at the risks because this company still operates in a very sensitive part of the market. The biggest risk is credit quality. A large portion of SoFi's revenue still comes from personal loans. So if the economy weakens and default rate rise, profitability can come under pressure very quickly. Recent analyst discussions have also focused heavily on SoFi's personal loan exposure and how sensitive the business is to consumer financial health. Interest rates are another major factor. Higher rates can slow down borrowing demand and increase pressure on consumers, while lower rates could help loan growth and refinancing activity. That's one reason why the stock has been reacting strongly to Federal Reserve expectations recently. Competition is also intense. SoFi is competing against traditional banks, fintech platforms, and digital-first financial apps, all targeting young consumers. At the same time, larger banks are investing aggressively into digital banking, which could reduce SoFi's technology advantage over time. And another important thing investors are watching is sustainability of profitability. The company has finally turned profitable, but the market now expects SoFi to maintain strong growth while keeping margins healthy. That's not always easy in lending businesses, especially during uncertain economic conditions. So overall, the opportunity is definitely there. But this is still a company that depends heavily on execution, credit quality, and the broader economy. Alright friends, this is the last part of the video. My overall thoughts on SoFi Technologies based on the fair value calculation is, SoFi does look slightly expensive at current levels. A lot of future growth expectations are already priced into the stock, but at the same time, I still see a strong long-term potential in the business. One of SoFi's biggest strengths is its younger digital-first customer base. Consumer behavior is clearly shifting away from traditional banking and toward app-based financial platforms. And SoFi is positioned right in the middle of the trend. What also makes the story more attractive is that the company is no longer just chasing growth. It has already started generating real profitability while maintaining strong revenue growth. So, in my opinion, this looks more like a hold in the short term due to valuation, but potentially a long term buy because of its upside potential and long term growth opportunity. Thanks for watching, everyone. More stock breakdowns coming very soon. Until then, stay smart with your investments. Cheers. Bye.